You might be considering getting into the stock market, or maybe you're now in the phase where you're doing your research because you want to start being an investor, and you keep coming across this particular term everywhere. You keep reading about it, but you don't understand what it is, and it's even confusing you when you check it out. Even your broker says to you, oh, actually, you need to open a margin account to do that. You have no idea. Well, today I'm going to be sharing with you what exactly margin account actually really is. So grab your notepad and your pencil and your glass of water. It's the Financial Fixer Show. Okay, I'm going to talk to you today about margin accounts. But before I get into that, let us learn the fundamentals. So you know about current account, cash account, your savings account, you know all that, right? So current account or cash account is really, let's say you have £500 or $500 in your current account or cash account. That is your money. And if you want to buy something that costs £500, you can just take out your £500 or $500 and buy that thing. That is your current account, your cash account, right? Savings account is the same thing. You are saving money into your savings account, like your emergency fund. You can put money in there and you don't touch it. It's earning you very little interest, but you don't mind. You are just going to leave it there. Your savings account, when you've got emergency and you want it, you can cash it out. You can take the money out and sort out that emergency stuff. Whatever amount is there belongs to you. Okay. If you want to do trading and you want to maybe start off with $100 or £100, if you want to take the money out of your current account or your cash account, you can take $100 or £100 out of your cash account or current account and start trading, or you start investing in the stock market or whatever. Right now, when we are now talking about margin accounts, I'm not talking about profit margin, net margin, all of that stuff, profit that you get when you have maybe sold something and you've gained a profit. We're not talking about that. Margin account should be called a debt account. Really. So this is where I need to explain it to you. Your margin account, this is when you start to get into trading or investing, is really debt, or you could see it as a loan. And how does this work? You have a broker, for instance, right? What happens is your broker is your lender. Your broker, they have loads of clients, right? They've got a lot of clients, and these clients, they've got shares in different companies. So remember, margin account allows you to take out a loan, allows you to borrow money, and you're borrowing the money from your broker. Let's put this as examples. For example, so you open up a margin account and you put in £1,000 in your margin account. Remember, margin account, you want to buy X number of shares, right, from a company. And let's say one share costs maybe £10. One share costs £10, right? And you have £1,000. You have £1,000 in your margin account. You can quite happily buy your shares. You have 100 shares, right? With your £1,000, you're happy. Life is golden, right? You say, yep, that's fine. But then you could now say, okay, I want to get more money. So you go to your broker, and remember, your broker has other clients. You go to your broker and you say to your broker, I want some more money because I want to buy more shares, right? You want to get more debt. So your broker says, oh yeah, that's fine. We'll give you the money. How do the broker get the money? They get the money from one of their clients. For example, let's say one of their clients owns some of those shares. Remember, they give you an additional £1,000, right? So you now have £2,000. You have your £2,000. Remember, this is debt, so they will charge you interest on that loan. Let's say it's a 5% interest, right? So you now have £1,000 plus your other £1,000. So basically what you now have is you now have increased, you have the leverage increases your buying power. So this debt, they call it leverage as well. The leverage, so leverage is basically a debt. You can see it as a fertilizer that has been added to your seed, which is like your £1,000, to make it more, to make it produce more. So you now have £2,000, right? And your £2,000 now, you can now use it to buy more shares. Okay, so your shares, you now have 200 shares. But remember, you still owe the broker £1,000 plus 5% interest, which is like £50. So basically, this is how much you actually owe the broker. This is the amount of money you will need to pay the broker back when you have sold your shares. If, for example, now you find out that, oh, things were really going well for this company that you have shares with, things were really going really well, and the share price increased. So you now have one share in that company is worth 15 pounds. So it's gone up by £5, right? And you're like, ooh, I'm gonna sell my shares, right? You're going to sell all your shares that you have, the whole 200 shares that you have. So 200 shares, you now sell that. How much would you get? So you work that out. You really do not need to do the maths. It's that easy. That is how much you make, right? I'm just showing you how to do the maths. So you now have £3,000 that you've now made. Now remember, you borrowed money, right? And remember that the broker charges you interest as well. Since you are also paying ongoing interest to the broker for the margin account, your investment not only has to do well, it has to do well enough to cover all your fees. And your interest is 5%, right? Maybe there are other fees, I don't know, but let's just make it simple. You need to pay back 1,050 from our previous what we did. So you subtract, and that will be how much money that you have made from trading on the stock market, right? So that is how much you have made after you've paid them. So what is your profit? You started off with 1,000, you borrowed another 1,000, you paid some fees on that. This is now your profit for that. Okay, this is when the shares goes up. This is the amount you get when you do it with margin, right? You borrowed more money, so that you borrowed more. You borrowed £1,000, right? Now, if you did not borrow any money, you had 1,000, you have 1,000, and then you bought 100 shares, and it costs £10, and then it goes up, the share prices goes up to, let's say, £20. Now you have for one share is £20. You choose to now sell your 100 shares. You choose to sell all your 100 shares. That is how much you have, right? When you've sold all your 100 shares, you get £2,000. How much is your profit? Your profit is £1,000. Right? Okay. And that is all your money. If we now use the same example, it costs £15 now for one share. How much are you going to now get? So your £15, you now have your profit is £500, right? Is all yours without using debt. Okay. Now, let's look at a scenario when the share prices goes down. If, for example, your shares now drops, they now drop from £10 to, let's say they drop for £7.50. So one share is now worth £7.50. So we started off with one share worth £10. Now it is worth £7.50. You have, if you're using the margin, so we're going to start with the margin. You took out a £2,000 in total, got 200 shares. So you have 200 shares now, and you're like, oh my God, this has dropped, I need to sell. And then you now choose to sell. So you do the math. So 7.5 times 200. The decimal point moves, that crosses 75 times 20. So you can just quickly do 75 times 2. 75 times 2 will make the maths a lot easier. And then once you've worked out 75 times 2, you just add the 0, right? That's how you do the maths quickly. So this is how much your shares now is worth. £1,500. Okay, remember you took out a loan and you're being asked to pay that loan back. The broker wants their money back, and it's with interest. So you need to pay them back with interest. So now you have £450. So you started off with £1,000. You took out a loan, right? You took out a loan plus interest. Now you're left with £450. You've lost money. Yeah? Okay. So that is in that scenario of using your margin. Let's say you did this without the margin. You did this with just your £1,000 and the share price dropped to £7.50. It's one share. How much would you make? You have 100 shares. Yeah. How much is your money now that you have? You will see that. So you do the same sort of method, okay? And you move the decimal. That's how much your shares are worth, and that's how much you have left out of your £1,000. So your share price is now worth £7.50, and you have 100 of those that you bought with your own money. Because it's dropped, you now have your shares being worth £750. So it's gone down from your £1,000 to £750. So you can compare that with when you got a margin. If you had gone for the margin, the amount of money you would have left is £450. Without the margin, you just have £750. Let's now look at another scenario when the share price now drops a lot more. So you were like, okay, you were hoping that it's going to go back up and you can make some more money, right? But it doesn't go back up, and you've been holding all this while. So you've been holding on to the money and it doesn't go back up, but instead it goes down. Let's say it now goes down to as low as, let's say, £5 for one share. Okay, and remember you took out your margin of which you need to pay that back, and you have £200 shares. How much is your shares worth? Your shares now are now worth £1,000. You need to pay back the broker, and you need to pay him back with interest, because the broker took the money from a client and the client wants their money back. So what happens? You only have £1,000. You have to give that money to the broker. They don't care where you get the money from, as long as you pay them back their money, right? So this is when basically the broker has now they call it margin call. So if you don't sell, your broker will contact you with a margin call. And basically what this says is, this is a request to add more money, more margin. It's a request to add more margin to back your loan since your shares are worth less money. If this happens, so you have to pay this amount back. You only have 1,000, so basically you are in debt, right? Where are you going to get the money back? Where are you going to get the money? If you cannot pay, your broker will pursue you for the debt and you have to pay the debt. Now, this can be a lot more. It can be a lot more. Your share price can go all the way down to even £1. And when that happens, what would you do? You are not even able to pay your broker their money back. This is when they will pursue you for debt. And this is how people get bankrupt and they get in so much debt, and some of them might do unbelievable things to themselves. A margin account is really a debt account. It's an account you tend to use when you are trying to do trading or some form of investing. So what that is you ask your broker to lend you some shares, some stock, and the broker lends that to you, and you have that in your margin account. You can use that to trade, along with maybe you have your own money that you've invested in that account as well, and then you use that to trade. That is trading. It is really debt. You're borrowing money from your broker and you're leveraging debt to try to make you more money. Now, if you want to know ways that you can use your margin account, then watch the next video. Remember, with the margin account, your broker can come and then ask you for their stock back, for their money back. They can ask you for that, and even sometimes they can just take their money without even letting you know. Remember, the broker can come at any point and say they want their stocks back, they want their shares back. And even in some occasions, they can just sell off the stock without even letting you know. Want to know how you can use your margin account? Then watch the next video. Just click on the video you see on your screen and it will take you there. My name is Gospel of the Financial Fixer Show. Thank you so much for watching. Remember to subscribe, disintegrate the like button, and I'm wishing you ongoing success. I'll see you in the next video.